Okay, we're going to get started. Please relax, find a seat. I want to introduce Peter Fisher, who I'm pleased to say is tonight's keynote speaker. He's currently the Distinguished Senior Fellow at the MIT Golub Center for Finance and Policy, so we are lucky to have him for the year. He's going to be teaching his course, which he calls The Arrhythmia of Finance. For those of you who are students, I can't recommend it more highly. It's going to be a very special course. But he's back here tonight for an encore to the very memorable keynote speech he gave at our inaugural conference all the way back in 2014. And it's a talk I actually still quote from. In fact, Peter is famous for many things, including his ability to coin phrases that really capture the essence of important issues. And so I think we'll get that tonight, too. So an important goal of these conferences is to bring together high-level policymakers, practitioners, and academics in a forum that fosters a meaningful exchange of ideas. And it occurred to me that in Peter, we have someone who has distinguished himself in all three of these roles. So he, after graduating with a JD from Harvard Law, the first part of his career was spent in public service. From 1985 to 2001, he worked at the Federal Reserve Bank of New York, eventually as an executive vice president, and he was the manager of the Federal Reserve System Open Account. Then from 2001 to 2003, he served as Undersecretary of the US Treasury for Domestic Finance. The next phase was he embarked on his private sector career, joining BlackRock. There, he held a variety of positions, including head of fixed income portfolio management and chairman of Asia. He more recently led their global retirement initiative, and he continues to work with them as a trusted advisor. Even more recently, he turned his focus to education, teaching at Tuck at Dartmouth, starting in 2014 through 2021, where he developed new courses and new approaches to pedagogy that he's going to bring to MIT this year. He has lent his insightful counsel and always constructive and modestly delivered ideas to many, many other entities, too numerous to mention here. So I'll just say that we're delighted to have him to speak to us this evening. So please join me in welcoming Peter Fisher.
Thank you, Debbie. And let me also thank all the presenters and discussants and speakers on the panels today and tomorrow. I think it's just been a marvelous mix of important ideas that we're trying to discuss. And they've all inspired me, although I could have referred to almost every paper and every panel. I'm not going to do that. I'm going to stick to my knitting. And so let me just state simply, U.S. fiscal policy is not sustainable. My talk is on the sustainability of our untethered fiscal policy. So federal revenues and outlays are untethered from each other. We foresee ever-rising government debt. Now, I'm going to try to draw a distinction I want you to think hard about, because our fiscal position could become more sustainable in two very different ways. We might better align revenues and outlays at their source, reducing expected future debt. Or, without a change in the trajectory of debt, we might better manage the consequences of whatever level of debt we happen to have, as best we can for as long as we can. Our untethered fiscal position is a consequence of our untethered politics. The absence of any coherent relationship between federal revenues and expenditures follows from the absence of any coherent national political dialogue. To fix our fiscal imbalances at their source will require a change in political will. to make any given quantity of debt as sustainable as we can without economic damage will mostly be a consequence of the competence of the Federal Reserve. Eventually, we will hit an inflection point when the Fed's capacity to manage will be overwhelmed by the quantity of debt, and the Fed will be unable to delay the reckoning any longer. But an incompetent Fed could bring that date forward. That's the nature of my talk. It's rather somber, so not really suitable for dinner, but I'll try to liven it up a little bit. We'll try to ham it up. So Dana and Debbie and others have already referred to the financial report of the United States government that has painted the picture, as Michael explained, of unsustainable debt. The report conjures 5.7 trillion of total liabilities and 4.5 trillion, 5.7 trillion of assets and 45.5 trillion of liabilities, yielding a negative position, as Debbie showed you, of 39.9 trillion. And the cash flows similar to the ones I think Dana showed, the fiscal long-run fiscal projections for 75 years, the present value of non-interest spending over the present value of total revenues is a negative 72.7 trillion. Now, this seems to defy financial logic for me. I learned about for every asset a liability and for every liability an asset and stuff like that. So the question for me is, how is this possible? I mean, how does this even happen? And that's where Debbie has already referred to. 20 years ago, I described the U.S. government as a gigantic insurance company with a sideline in national defense. Now, that image has had some resonance, and it's always nice to be remembered. But actually, I failed in what I was trying to convey. So my tombstone may have on it, giant insurance company with an army. But in my experience, I failed. I was trying actually to convey something else, that the U.S. government was not really an insurance company at all, because it did its accounting on a cash rather than accrual basis. And I was trying to draw attention to the long-run negative position then. And even more to the point, I said as a phony insurance company, federal finances are an accident waiting to happen. And like others, I was premature in that forecast. So how was I so wrong? I'm 20 years, had a bad forecast. With hindsight, I can see I missed two features of our political economy. First, I missed the importance of the unrecorded asset that the federal government holds in the option to tax the U.S. economy at a different, higher rate in the future. The bond market has to confront the risk that fiscal prudence there might be an outbreak of fiscal prudence in the future. Now, I don't know how to price that option. I don't know if it's accurately priced today, but I do know I did not think carefully enough about it 20 years ago. I needed Mindy's help 20 years ago to do all that math. Second, and more importantly for what I'm going to talk about this evening, I missed the importance for fiscal sustainability of our having a more or less competent central bank. The origin story of central banking has much more to do with sovereign fiscal sustainability, one way or another, than with controlling inflation per se. I'm going to come back to that. So how has our untethered fiscal position come about? Now, Dana's chart showed this, but I want to drive this home. Our untethered fiscal policy has taken place in this century. It's just the last 25 years. That's where it's become untethered. You can't find a fiscal signal between revenues and outlays. And as Dana's chart showed, we have a sort of persistent downward trend in federal revenues toward 17% of GDP, and a persistent uptrend of federal outlays to 20% and beyond with big spikes, and that gives us the persistent 4% gap, 4% of GDP that's persisted, which I believe accurately reflects our untethered politics. One of our political parties has a dominant impulse to lower taxes and a lesser impulse to lower spending. The other party has a dominant impulse to increase spending and a lesser impulse to increase taxes. Each party's rhetoric relies on a reciprocal false premise. The former, that there's a realistic path to balance from cutting sufficient outlays alone while still lowering revenues. The latter, that there's a realistic path to balance by raising sufficient revenues while still increasing outlays without broadening the tax base and raising taxes on the middle of the income distribution. So our politics and our policies could become at least tethered if our political parties could mutually recognize their reciprocal false premises. I think that's the threshold condition. And that neither party's rhetoric offers her a path to balance, and therefore that solutions required a shared and integrated appreciation of different ways that balance might be achieved. But as long as they keep talking past each other and the dialogue of the deaf continues, our fiscal position will continue to deteriorate. Now, the untethering appears to me to have followed from the rise of the Hastert rule in the House of Representatives 25 years ago, the enforcement of which prevents the minority party from bringing bills to a vote unless a majority of the majority party already supports the bill. Now, this really originated with Speaker Gingrich, but Hastert has the naming rights. A byproduct of the Hastert rule has been a marked decline in the once significant powers of the chairman of the House Ways and Means Committee to forge governing coalitions on tax policies across party lines within the committee. Now, if we eliminate the rule, this isn't going to give us fiscal balance. But my point is, I think the rule was a trigger, was a tipping point for the primacy of partisan politics over policy. So now you ask me, how and when will political forces change to create greater fiscal balance? I do not know. I don't know how we're going to change the political will. I have no insight here. So I'm going to fall back on urging you to read George Washington's 1789 farewell address. His language is inspiring, but his logic is jarring, upsetting. He explains, first, our liberty and happiness rest on a foundation of national unity. Therefore, we should resist, 1, regional jealousies and geographic discriminations. 2, the baneful effects of the spirit of party, the alternate domination of one faction over another. 3, both antipathies and passionate attachments to other nations, all because of their threat to our national unity. But he goes on, our form of government depends upon, 1, virtue or morality as the necessary spring of popular government. 2, the primary importance of institutions for the general diffusion of knowledge, as it is essential that public opinion be enlightened. And 3, near and dear to our hearts here, as a very important source of strength and security, cherish public credit. Use it sparingly, but when needed, bearing in mind that towards the payment of debts, there must be revenues. So at least Washington helps us see what we're up against. So now I'll put aside the question of whether we can change the political will in America, because that's way too hard. So then the question is, without a change in political will, what sustainable fiscal futures can we imagine? A spontaneous outburst of fiscal prudence, as Debbie said earlier, seems unlikely. 3 alternative futures are often discussed: higher growth, higher inflation, and higher interest rates. Higher growth would also be welcome and could improve our fiscal position. But to resolve our unsustainable debt trajectory, higher growth would have to be combined with political inaction, with political forces accepting higher revenues and lower outlays as shares of GDP. While it may be easier, I think it is easier, to imagine additional revenues being raised by political inertia and acquiescence than by political initiative, this future does require a change in political will. And over the past 20 years, higher growth did not prevent, but rather encouraged decreases in taxes. So, how about higher inflation? Well, just the right amount of higher inflation could erode the real value of our national debt without a need for a change in fiscal policies. This is conditional on inflation being just high enough to reduce the real value of the debt, but not creating other disturbances. I'm skeptical about that. This would also depend on these conditions persisting for an extended period, which should be distinguished from brief bursts of unexpected inflation, which seem on occasion to succeed in lowering the real value of debt. But it requires this brief unexpected. And finally, I think this requires an effective financial repression, which in our case today I find implausible. Now, let me acknowledge financial repressions worked in our past and in other countries. But we Americans, over the last 20 years, have become particularly inept at drawing a tight boundary around our banking system. Our capital markets, particularly their current crypto and private markets incarnations, are not likely to trap trillions of dollars in assets with persistently negative yields for the many years this would take. So this future seems conditional on a change in our political economy that I also find improbable. So finally, higher yields on government bonds anticipating higher borrowing requirements could force a change in political will. Now, I want to distinguish some increase in term or risk premium from anticipated increases in supply, which I anticipate, from a dramatic return of the bond market vigilantes, which seems unlikely to me. For this future does require a change in political will. It's just one we imagine the deus ex machina of higher rates forcing on our political class. It's again a trick of changing the political will. Second, the bond market vigilantes of your imagination did not exist in a state of nature. They were conjured into existence by Paul Volcker. In the late 1970s, yields on Treasury securities traded near and on occasion below the rate of inflation. As the bond market accurately predicted, the Fed would not fight inflation and traded right through. It was the credibility premium the Fed earned in the 80s and 90s under Volcker and the early Greenspan that led market participants to anticipate the Fed's inflation-fighting reaction function. So for a 21st century group of bond market vigilantes to deliver us to a sustainable fiscal future would require, one, a Fed that has trained the bond market to anticipate a vigorous reaction function. Two, a rising rate of inflation responded to by both the Fed and the bond market. Three, a public narrative about the causes of inflation and higher interest rates that includes our untethered fiscal position. And four, all these together cause a change in political will that leads to sustained change in fiscal policies. Now, as a matter of compound probabilities, this seems somewhat unlikely. But perhaps because we've seen it before, this future seems more vivid and more likely than the others I've described. So, I'm winding down now. How long can we tread water? By process of elimination, I believe we're thrown back on the competence of the Federal Reserve to delay as long as possible when we'll be overwhelmed by the quantity of debt. If we had no central bank at all, we would not have been able to sustain our economy at anything like our recent ratios of debt to GDP. We tried this in the 19th century when we had no central bank, and we experienced significant volatility in economic output, in boom-bust cycles, alternating periods of inflation and deflation, and acute episodes of financial instability. So having a competent central bank has allowed us to operate at higher levels of debt than we otherwise would have been the case. This is unsurprising. As I mentioned, the origin story of central banking has much more to do with sovereign fiscal sustainability one way or another than with controlling inflation. The history of the Bank of England is actually all about its origin and evolution as an instrument to support the gilt market. In fact, you go back to the origin story of the Bank of England, just a few years before the origin story of the South Sea Company, it was all about creating the distinction between debt held by the public and debt not held by the public. So even the accounting issues that Steve was talking about have their origin back there. So let me ask you to consider, without irony, the fiscal theory of central bank behavior. Seen through a fiscal lens, an effective central bank aims to sustain the value of the option to tax the economy in the future with high levels of employment and growth, the real value of government debt with a low rate of inflation, and the liquidity and efficiency of the government bond market with financial stability. This is not a coincidence. This is by design. The design of central banking has evolved over 300 years. And I feel this acutely, having played both sides of this equation, having played both the bond manager for the Fed and the debt manager for the Treasury. Now, there will come a point in our future when the ever-rising quantity of debt relative to the size of our economy will compel the Fed, by the logic of their own objectives, to engage in open-ended monetization of the debt as the least bad choice. For clarity, I would like us to label that the moment of complete fiscal dominance, so there's no mistake about what we mean by it. I'm not clever enough to have a useful opinion about precisely when that will come, but I know how it could happen sooner. We hope for a competent central bank, one that is trying in good faith to manage the trade-offs between growth, inflation, and financial stability, and in practice optimizes for all three. That's what we hope for. We fear an incompetent central bank, one that makes no effort to manage these trade-offs or is ineffective in managing them. Now, I have a preference for distinguishing the fact of central bank competence or incompetence from our causal theory of incompetence. Incompetence might be the result of overt political constraints on the central bank's independence of choice, but might also be the result of the central banker's own shortcomings, their own poor choices. Whether framed as competence or as independence, the critical question is whether the central bank effectively considers a sufficiently long horizon to make vivid a wide distribution of potential outcomes among all three of its objectives, so it can thoughtfully weigh the trade-offs. We call this time horizon, but as I'm increasingly skeptical about my own capacity for mental time travel, I have come to see this horizon less as a temporal destination and more as an active imagination of a wider distribution of prospective outcomes. You've been spared my trying to make this whole talk all about mental time travel. By its incompetence, the Fed can bring forward the bad outcomes we fear most, hyperinflation and default. Hyperinflation is self-evidently a combined failure of fiscal and monetary policy. The prospective causes of default are harder to pin down in advance. The debt manager in me has spent some time pondering that. But there can be both involuntary defaults brought on by a scarcity of central bank reserves or by a failure of demand for government securities in a failed auction. There can be voluntary defaults consciously chosen by the debt manager. That opens up a whole realm of possibilities that we won't be able to talk about this evening, but maybe some other evening in some other talk. So to sum up, there are these two different ways to think about sustainability: fixing our fiscal imbalances at their source, or managing the ones we have as best we can. To improve our fiscal imbalances at their source requires that we fix our untethered politics. These are not two problems, they are one problem. A problem whose solution will be possible only when our political parties can acknowledge the reciprocal false premises on which their positions are based and find common ground somewhere else. To manage the imbalances we have as best we can before we reach the moment of complete fiscal dominance, we rely on the independent good judgment of the Fed, which is in some jeopardy. In this sense, fiscal sustainability and central bank independence is also not two problems, it's one problem. Thank you for your attention and my rather somber talk. Debbie's asked me to take some few questions if people want to give me a hard time or ask me something lighter. How are my grandchildren or something? But I'd be happy to. Yes.
Dana Rowan, and I'm a guest tonight, but live locally here and have lived in the Boston area for 45 years. I'd like to know your thoughts about Stephen Mirren, who is, as a new member of the Federal Reserve, introducing sort of a dynamic model for, an exit strategy on our debt problem, and what your thoughts are about that. I mean,
About his exit strategy.
Yeah, he's expounded with this dynamic model that we're going to basically grow our way out of our current fiscal situation and need not worry about current, fiscal tightening.
Yeah, I mean, I don't. I'm not going to critique his model, but I appreciate the question. But that's, I think, my comment that requires political acquiescence. We have 25 years now, a quarter of a century, in which our political parties are perfectly prepared to keep adjusting taxes and spending policy to keep outlays above 20% and revenues down toward 17%. So if the numbers come in differently, they're free to change their behavior, unfortunately, in an unproductive direction. So he's got to have a theory of how he's going to change political will if he's going to get us to balance. He can't just have a model. It's not just about telling me what the growth accounting is. Other questions? Yes. Hi.
So, Peter, I'm Doug Elmendorf.
Yes, good to see you.
I teach a little up the river here. I'm surprised you're so skeptical of bond market vigilantes, involving both logic and evidence. So the logic, I would say, is that if there's a vastly growing supply of government debt, then unless there is some corresponding boost in demand, just the standard equilibrium in the market should push up the interest rate on government debt in a way that could change the political dynamic. And the evidence, I would say, is that we've seen vigilantes in other places that don't seem particularly influenced by Paul Volcker. So, for example, in the UK, a few years ago, to Prime Minister Truss's detriment. So I'm surprised that you seem dismissive of the possibility that what we'll see will in fact be some run-up in interest rates that will then change the economic and political dynamic.
That's a great question. Good to see you. I've meant to allow that some increase in term or risk premium from rising supply I expect. Now, the idea of a bond market so violent it intimidates our political class to change its behavior is what I'm skeptical of. I see a series of steps. Now I'm going to unpack two recent examples. The mini budget crisis in the UK was all about some terribly incompetent hedging of interest rate risk by UK pension funds. This was not foreign holders or anything else. I was a little too close to the dynamics. I came back to BlackRock to work on big retirement issues, and a few people said, "Oh, you're back. Would you please go to London and help us with this?" So that was really a very peculiar episode that had to do with profound incompetence in unwinding interest rate hedges. That a little bit of volatility didn't have to be that bad. The recent episode in France, I think, is instructive because I think we still don't know whether what we're watching is international investors better appreciating political difficulties in France and supply constraints, or is it that the bond markets understand there's no ECB bailout for bond markets as big as France and Germany? So it's a mixed bag of whether that's the supply constraint or, oh, the competent central bank isn't here to try to smooth things over for us. And I think it's better thought of as a mix of both that's hard to discern. So, but you're asking, but partly I'm cynical about the idea, or I'm skeptical, probably better, that somehow the bond market is going to force the hand of Congress. And that requires a level of violence and congressional appreciation that they're the cause of this. That's part of what I don't see. That's why I say the compound probabilities of my foursome is what is really the basis of my skepticism. But that's a great challenge and a great question. Other questions? Here comes the mic. I'm hard of hearing, along with having grandchildren.
Well, they're related phenomena. Okay, so I took a core portion of your message as being we needed to have a competent central bank, and that competent central bank was going to allow us to continue along on the kind of path that we're on now. And so I'm imagining being 20 and I wish it were true, but I imagine being 20 and thinking,
kind of time travel.
Yeah, and looking at this and saying, I don't think I really want a competent central bank right now. I want them to get this, have a crisis, get this over, get it resolved. I don't want the central bank allowing for continued postponement. So it's a hypothetical, and I'm curious about your reaction.
Yeah, I guess I'm worried about the 40% inflation and the jump to hyperinflation that comes if you think you have an incompetent central bank, not just one who's goofed. You know, we goof. We goofed in the pandemic. The Fed had a goof. But a sort of endemically incompetent one that's not going to be able to do anything. It's going to put all the chips down on growth now and not give a damn about inflation or financial stability. And for me, that's the incompetent central bank. And I would advise that 20-year-old that you might not want to run that experiment. You might not be happy with the place you end up. I understand the temptation. That's what I said. The Doug asked me about my scenario of the bond market vigilantes. It feels more vivid because we've seen it before. Yes, it is more vivid for us. We lived that. The 70s and 80s and into the early 90s, and it took a long time, and Bill Clinton came along and Bob Rubin, and they did a little something, and we got a surplus. It was a near thing. I mean, there was no guarantee of that, and no one's forecast predicted those surpluses. I know that because we were the first to predict it at the open market desk, forecasting the Treasury's general account. Official Washington had no clue that was coming. So it was not quite an accident of lots of productivity advances. So that's it's a riverboat gamble your 20-year-old wants to take. And that would be my counsel. It's a little like the riverboat gamble of the people who want brief episodes of painful inflation to erode the value of the debt. Well, that's a little too close to inflation too high for my taste. But Maybe a risk-taking 20-year-old will want to do that. One more question, and then people get to eat, I think. Somebody? Debbie's...
My question is very similar to Bob's, but maybe I'm going to phrase it a little bit different. I said my question is very similar to Bob King's, but I'm going to put it a little bit differently. Imagine I'm riding a bike down a very steep hill, and there's a brick wall at the end of it, and I have no brakes. So the question is, do I jump off the bike soon when I'm not already going too fast, or do I kind of wait for that inevitable crash into the brick wall, even though I don't have any brakes that I'm aware of that are going to change that outcome? So I think, in the spirit of what you're asking, it isn't so much that you want an incompetent central bank, but if it's just going to postpone what will become a worse eventuality, maybe we want a temporarily less competent central, do we want to precipitate a crisis sooner rather than later? Or when is the time we have a crisis if we don't have a solution that avoids an eventual crisis?
Well, I don't want to run in the brick wall. We never want to run in the brick wall, but I don't know that I have the choice. That's my point about we're thrown back on the competence of the Fed. I mean, we may not get a good outcome here. In fact, I think that's probably the better forecast at this moment. We're not going to get a competent Fed. I mean, I could have, but projecting the bond market vigilantes will anticipate a vigorous Fed reaction function right now seems like a threshold condition that just isn't going to come. So I think we're right to be nervous about running down the path toward hyperinflation. I'd still have a hard time saying that because I think something should intervene. I'm not sure jumping off the bike is going to be the thing that's going to intervene. So I understand the wish that something would come along and disrupt this. That's why I went through the litany: higher growth, higher inflation, higher interest rates. Those are all the three things that we think are going to interrupt this, but kind of like Deus ex machinas that'll come down from above and change the story for us when we imagine this future. Now, I think we can hope the bike doesn't run into a wall or whatever, but then we're something that we don't yet have in evidence. But there's something else which I'm happy to be pressed on this, and it's not really, is the Fed, the last 20 years, the Fed has been clever about this than I would have predicted 25 years ago. The Fed has gotten us through some bouts of instability that I would have thought would have been more disruptive than they'd been. So I don't mean to count out the competence of the Fed to push back the brick wall a little bit. It's not quite as near as we thought. Even though I know there's a moment of complete fiscal dominance, I don't mean to fight that. On that jolly note, let's all have something to eat. Thank you.